You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Thanks for tuning into Mining Stock Education. And in today's show, we will be doing our quarterly check-in with Dr. Rob Stevens from MiningEssentials.com. Wrote an excellent book. If you're newer to mining investing, I encourage you to pick up his book, Mineral Exploration and Mining Essentials. In today's quarterly check-in with Dr. Rob, we will be going over the copper markets, its supply and demand fundamentals, as Dr. Rob has researched it, as well as copper deposits and what are some of the key things that you should look for and look out for in investing in a copper play. So, Rob, thanks for joining me again, and please take it away.
Thanks, Bill. Yeah. Good morning, everybody, or afternoon, evening, depending on when you're listening. Thanks, Bill, for the opportunity to check in again with your listeners and talk a little bit about what I think is a really interesting topic, the copper market and the copper demand. I'm sure anybody who's involved in the metals world has been hearing a lot about copper, really in conjunction with moving towards a low-carbon economy and an electrified economy. Copper being that metal that conducts electricity far greater than really any other metal. So that its likely demand scenarios are going to be significant. So I think it's a timely and interesting topic to dig into. So let's just go at it and get onto it. So, right, one sec. There we are. So as you mentioned, Bill, I'm going to look at three main topics for this presentation. Copper supply and demand trends. So what are people currently thinking in terms of the supply that's out there and then the demand that's arising? We're going to touch a little bit on copper mineral deposits. I always think it's good to have a bit of a sense in your mind of what is that geology that people are exploring. If you're a junior company investor, I think it is good to know what are people exploring. What are the size, shape, grade, and tonnage of those deposits? That can really help you understand the kind of drill hole intersections that you should expect from a really good quality deposit, and help you interpret those drill hole intersections. And then at the end, just a few sort of wrap-up comments of things that investors can think about around the copper market. So let's go into copper supply first. And there's kind of three themes here that I want to look at in the copper supply, starting with these slides here. So the first issue is supply is increasing slowly. And for those who are on YouTube, the left-hand image here shows copper production from 2010 to 2021. And this is some data from the U.S. Geological Survey. So it does show a steady increase in copper, but not by much. I mean, if you look from, say, 2016 to 2021, we're looking only at a 3-4% increase in copper production, and annual increases in the 2 to 3%. So it is going up, the amount of copper supply coming onto the market, but not significantly at this point in time. So that's the first point. The second one, which is the slide on the right here, is that major new discoveries of copper deposits are slowing down. And most new resources that are then feeding into some of this mine production are coming from existing mines. Now, that's important. I mean, existing mines almost always have additional resources that can be put into production, and that is always an important part of the supply. But at some point, those mines will run out of resources, and we need new discoveries and new mines to come on to replace that, and also if there's demand increase, to feed into that new demand. So this chart on the right here, which primarily takes data from S&P Global Intelligence, shows major copper discoveries actually all the way back to 1990. And a key point is, over about 2 decades, there was an average of about 10 discoveries per year, but only 16 major copper discoveries have been made in the last 10 years. And so the number of discoveries, and on the chart here, it shows that in 2017, 18, and 19, there were no major discoveries. And that is even despite there being a pretty good amount of dollars put into exploration, again, on this chart here, there's a line that shows copper exploration budgets. So copper budgets are doing well, but the discoveries aren't coming. So that's really a concern for the supply in the next 5 to 10 years. It does take a while, obviously, from a discovery to production. So it's really suggesting some real risk in terms of supply in that 5 to 10 year time frame. And here's another one that we've known about for some time on the supply side, is that copper grades are decreasing. So this particular chart here with some data from Wood Mackenzie shows sort of average copper grades from 1990 and projected out to 2030. In 1990, average grades were about 1.6% copper. If we come to today, we're maybe at 1 or a little bit less, and going forward, it's suggesting it'll get even lower than that. So that's going to put pressure on the price as you're mining lower and lower grades. Of course, your cost per ton of copper produced goes up. Now, technologies are improving, and we are able to mine cheaper than we did in the past, and that is partly why grades are going down, because we are able to profitably mine lower grade deposits. But it is putting pressure on the system. Ultimately, you can only go so low grade, and it's also putting supply pressure because you're just not, for every ton of ore that you're mining, you're not producing as much copper. So, when we look at fairly steady state production, we look at a real lack of new discoveries, and those mines that are being mined are lower and lower grade. It really puts some challenges on the supply going forward. Now, if we go to the demand side and look at that, so there's lots of different data you can find out here. What I've chosen is a recent study by S&P Global Intelligence on copper, both supply and demand. And what they're suggesting is that the copper demand is quite likely to double, essentially, between today and 2035. Now, they're basing that on the premise that we will meet, or that globally will meet the U.S. and EU net zero targets by 2050. And really, to get to those net zero targets by 2050, you got to back up before that. And so the amount of copper that's really going to need to feed into the system to produce the electrical network to feed into, for example, electric vehicles is going to happen by 2035. And so the chart here sort of shows that increase, but I think what's also important to know is it's not just about electric vehicles and that transition to a low carbon economy. Copper is used widely for many uses across our society, and that is going to increase as well. It's not as if that's stopping. And so the two of those put together really show a significant increase in copper demand, particularly between now and 2035, but continuing beyond that. So that leads to looking at then this supply-demand balance. And this, again, is from the same study by S&P Global Intelligence. And what they did is they looked at a couple of scenarios. And so if you're looking at the image here, I'll just start with the gray line at the top. And so for reference, here's 0. So that would be supply and demand are in balance at 0. Above it means there's more supply, and below it means there's not enough supply. And they looked at two scenarios. One they call a high ambition scenario, which is sort of highly optimistic assumptions about recycling, which is likely to be also an important source of supply for copper, and also capacity utilization of mines and refineries, improving their efficiency, getting more out of the existing deposits, etc. And then they took another scenario, which they call the Rocky Road scenario, which is basically a continuation of recent recycling and capacity utilization rates. So again, in this Rocky Road scenario is where we really see a huge supply deficit peaking at about 2035. Now, realistically, we'll probably be somewhere in between there, but in both scenarios, they show a fairly good deficit by 2035. And so, whether you take status quo or the best scenario going forward, there's a real supply issue likely coming. Now, I do note here that the peak of that supply deficit is in this modeling anyway in 2035, and that it improves as we go forward beyond that. I guess that's the expectation, that prices and other things will encourage more supply to come onto the market. But as we know, it takes a long time to permit a new mine. So if we start ramping things up in the next few years here, that's really only going to show up in that increased supply and addressing that imbalance after 2035. So what does this mean then when we have this supply-demand imbalance? So, I mean, the obvious one is it's likely to lead to higher copper prices in the medium term. I feel that prices in the $5.50 per pound or higher at some point in the next few years are going to be very likely. You can find quite a range of projections out there, some suggesting higher than $9 a pound. I've read others sort of feel that it's likely to be steady state in the $3.50 to $4 range, $4 range per pound. I think that's probably a little bit low, but there isn't a tight consensus on this, other than I would say most feel that there will be a pretty good copper price going forward. Now, the other part is when you have a supply-demand imbalance or a gap, that will lead to some kind of response. We're going to have to either fill that gap or do something else to address those issues. And I say that because depending on what some of those responses are, it will influence the price. And so let's just look at what might be some of those responses to this gap. So obviously higher mine production, that's going to be key. And we've already touched on that. We need more discoveries, and we really need to get to that point of higher mine production. More recycling. I think that's important. Copper, it can be quite readily recycled, and I think that if prices do go up, we'll certainly see more demand for that. Unfortunately, I remember last time prices went up, it led to a lot of people trying to steal copper, and they weren't always so smart about it because they were stealing live wires sometimes. But we don't need more of that, but more recycling would be good. Faster permitting. Of course, we'd all love that. It'd be nice to see a new discovery get into production in just a few years. And you do hear governments talking about that. I'm based in Canada. I hear our federal government talking about that. Whether that results in action, I'm not really sure, but that could be an important one. I think probably an inevitable reality would be slower adoption of electric vehicles and technologies. Simply, there may not be enough supply if we don't have enough copper. Those prices might become so high that people are just not buying, for example, electric vehicles this year. They're going to wait 3 or 4 years. I think we've seen this a little bit in Europe, that the move towards alternative power when there's a bit of a challenge as a result, in this case, of the situation in Ukraine. They weren't quite ready for those for that move to alternative power. So I think we will see slower adoption, which will decrease that demand for copper a little bit. Breakthrough technologies, alloys with higher conductivity. I mean, copper has such a command because of it really being the top of the pile when it comes to the ability to conduct electricity. But if it's really expensive, people are going to be putting a lot of money into research to look for alternatives. So that's a possibility. Substitution as well. Aluminum can substitute in some cases. Bill and I were talking about this. I mean, it overheats. It's not as good as copper for sure. It's a lot lighter though, which gives some benefits. So any sort of combination of these issues may come into play to address the supply-demand imbalance. So I'm kind of talking medium to long term here, out into 2035 and beyond. But why don't we just take a quick look here? Well, what's happening kind of right now to try and understand that situation? What we've got, 2 charts here from Kitco. The one on the left are copper prices over the last 5 years. And we can see here through primarily 2021, we were up $4.50, give or take a little bit. Dollars per pound for the price of copper, going quite strong. Now has dropped down to around $3.50. So it's pulled back some amount from those peak periods, which seems to not quite fit with this expectation of so much demand and not enough supply, and etc. Also, if we look at the chart on the right, this is copper warehouse stocks, specifically in the London Metal Exchange. But you could take a chart that had the London Metal Exchange, COMOX, and the Shanghai, and put it together, and it would show a similar trend, and that is generally decreasing copper warehouse stocks. So that's a concern. If there's a sudden pickup in demand of copper, there's not really a lot of warehouse stock available, and so that could suggest that a supply crunch, is not too far ahead of us if that demand picks up. But really, why are we in a bit of a lull here in the copper price? Why is it not continuing to go up or stay at 450 given all these fundamentals I've just talked about? Well, there's always short-term factors that come into play with metal prices. And so right now, potential for a global recession, or we're in one, depending on your perspective. Copper is really a supply-demand type commodity. So recessions reduce demand, and therefore the prices tend to drop down. Reduced demand in China, economic slowdown, and their sort of zero COVID policy has really reduced that demand in China. And as many people will know, much of the metal demand and metal price strength over the last 15 years, realistically, China's had a big influence on that, the demand in China. So less demand in China definitely reduces those short-term prices. A high U.S. dollar. Metals are priced in U.S. dollars, and a higher U.S. dollar makes metals more expensive, basically, for everybody else who isn't using the U.S. dollar. That can decrease demand a little bit. Oil prices as well. They haven't actually taken off all that much, but they've reduced back since the initial invasion into Ukraine. But high oil prices increase the cost of everything, and so that kind of puts pressure on the demand side. So I just say this to say, I think the medium-term fundamentals are very strong, but of course you always have to then put on top of that, well, what are the short-term issues that are also affecting copper prices? Okay, so there's a little bit of a outline of supply-demand fundamentals, and what people are talking about in terms of where copper's going in the next 10 or more years. I want to just come back to the geology a little bit now and talk about copper deposits. So as a primary source for copper, where is that coming from? And on here, we've got a chart from the United States Geological Survey, just breaking down where does most copper come from a mineral deposit perspective. The top is porphyry copper deposits. About 75% of copper is coming from those types of deposits. And they're primarily located in the Americas, right from, and the western side from BC right down through to the southern tip of Chile. There's a lot of good porphyry copper deposits all the way along in that belt. There's some elsewhere as well, in Southeast Asia for sure, and other parts of the world. The secondary source, as a single source, is then sediment-hosted, what are referred to as strata-bound copper deposits, only at about 10%. But these are they're really good deposits where you can find them, but they're fairly limited in distribution. Primarily in the Democratic Republic of Congo and in Zambia, in Africa, and there's quite a long belt of copper deposits in that area. And then in Poland, Germany, and in that broader region, there's also a good belt of deposits there. And they do occur elsewhere, but not that common outside of these main belts. And then we've got about 15% of other types of deposits. I would put the main ones down as volcanic massive sulphide, also known as VMS deposits, and magmatic sulphide deposits, which would be things like the copper nickel deposits in the Sudbury Basin or in Voisey's Bay. These are also important sources of copper. So I want to just take a look a little bit more at three types: porphyry copper, sediment-hosted ones, and the volcanic massive sulphide. just so you have a little bit of sense of what those look like, and then we'll take that forward to drill holes and what kind of drill intersections might you expect from these types of deposits. So here's a couple of images of porphyry copper deposits. Porphyry copper deposits are what we call hydrothermal mineral deposits. They are big bodies of rock. So one of the ways to think about a porphyry copper is a large body, oval to semi-oval in shape, with dimensions of hundreds or even thousands of meters, really in all dimensions. So they're big bodies of rock, and they form primarily at the upper parts of magmatic intrusions, where copper-bearing hydrothermal fluids coming off of those cooling magma bodies now beneath the ground send out or create a fracture network of small little fractures in the rock that each end up with a little bit of copper in it. So you end up with big deposits and relatively low grade. And I like the image on the right. For those who are able to see it, this is a model from the Cerro Verde deposit in Peru. Just for scale, the scale bars here on the grid are about 100 meters. So it gives you a sense of the bit of scale of it. And what we've got here, the red, is actually the copper deposit itself. Then we have a shell of an open pit, so the proposed pit that would be built to mine that deposit. And then you see all these little blue and gray kind of bars on here. Those are all the drill holes that were used to define this deposit. So that gives you a bit of a sense of what they look like. I like to call it blob-like, really, but it's a big body of rock, but typically with low grades. But go to the sediment-hosted copper deposits now. These are actually quite different. They're often referred to as stratiform or strata-bound deposits, which mean they essentially lie along sedimentary bedding planes. So they tend to be flat or tabular deposits rather than big round things. And they might extend laterally for long distances, but not necessarily be very thick. They are not formed, they still are formed through a sort of hydrothermal process, but quite differently. On the model here on the left, the idea is that you have a series of sediments that are rich in copper, and you get oxygenated fluids that are moving through those sediments, causing copper to dissolve into those, what we call basinals. So this is a sedimentary basin where sediments are sort of getting flushed into a depression, and the sediments are being deposited. And you get a lot of water movement in these sedimentary basins. And if you've got oxygenated water, it dissolves that copper. Those basinal fluids are then migrating up faults or other features within that basin, and then they interact with rocks that are reducing, so have a real lack of oxygen in them. What happens is you end up with a chemical reaction between your copper-rich oxygenated water and your oxygen-poor rock units, and that causes the copper to deposit out. And so in this model, you end up with right along faults, for example, because that's a good place for fluids to move. The red here are those stratiform copper deposits forming right at the intersection between where the two different fluids are sort of interacting. And on the right, this is just a model for a project that a company called Ashton Bay Resources is looking at in northern Canada. And I just like it because it sort of showed here's their copper targets, and they're bedded things. And they can extend, again, a long distance laterally, but they're not very thick and generally not super wide. So quite different looking than the porphyries. And then the last one I'll come to here is volcanic massive sulphide deposits. These are, again, a hydrothermal type of deposit. Similar to porphyry, they're generated by hydrothermal fluids coming off of usually a cooling magma source. And those fluids, hydrothermal fluids with metals dissolved in them, migrate up to the seafloor and come out at the seafloor as a hydrothermal vent. And what happens is then rapid cooling of that fluid that's filled with metals, it might be 350 degrees Celsius, hits the seafloor, cools really quickly. The metals deposit out as a result of that cooling. And you end up with what's often referred to as a lens-shaped body dominated by sulfide minerals. And one of those key sulfide minerals is, of course, the copper mineral. And so the model here on the right, for those that can see it, is a model of a massive sulfide lens. And just see the dimensions here. So there's 100 meters. So these things, can be several hundred meters, in diameter kind of thing, but don't tend to be quite so thick. So they're a little bit more like the sedimentary ones in that they're tabular, but they don't tend to extend laterally as far as the sedimentary, the stratabound deposits. So there's in a really quick nutshell, the three sort of common types that we're going to find copper in. And there's quite a bit on this table here, but what I think could be really helpful for an investor who's looking at copper, it's always good in my mind to understand what type of deposit are they exploring for. What is that deposit type? Because that leads to how big are the drill intersections you should expect, and what kind of grades should you be expecting from those drill intersections. So if I take something like porphyry copper, again, as I mentioned, they're big deposits, relatively low grade, 0.2% copper sometimes, maybe up to 1.5%. That'd be a pretty high porphyry deposit. Most of them are much less than that. And their dimensions are hundreds to thousands of meters. So if you're looking for a good drill intersection from a porphyry copper target, you want to see, I put 50 meters plus, other times I've said 100 meters plus, but you want long intersections, but they don't have to be super high grade. If you had something that was 0.2% copper and maybe 0.25 grams per ton gold or higher, that could be a pretty good intersection. The whole economic model with porphyries is, big tonnage, low grade, so you're mining a lot of tonnage, and your profits, relatively small per ton, but it's a numbers game. You're just pushing lots of rock through, so you can afford to have lower grades. So though, for a porphyry, you want to see big intersections, but they don't need to be that high grade. If I go to something like sediment-hosted, so their grades tend to be higher. Remember, they're sheet-like or tabular. So when you think about that, typically your drill hole intersections are not hundreds of meters, but meters to tens of meters, because these deposits are usually sort of, say, 3 to 50 meters thick. So if you're drilling right down through that, meters to tens of meters, but you're going to be looking for higher copper grades, 0.5% copper, maybe higher. Some of these have grades of averaging 3% copper. So, and there's going to be overlap between the two, but I think those are fairly different. Shorter intersections, higher grades. Likewise, I would say when you come to the volcanic massive sulphide deposits, these are more similar to the sediment-hosted. They tend to be sort of flat or lens-like, with dimensions of maybe a few hundred meters in diameter, but only 2 to 20 meters thick. So again, intersections that are meters in length, rather than tens or hundreds of meters. And often really what you're looking for is a combination of metals. One of the strengths of the volcanic massive sulphide deposit is that it is a multi-commodity deposit, usually with copper, lead, zinc, gold, and silver. So you're not always focusing just on the copper, it's the combination of all those metals. So maybe I can provide Bill with this table separately. You could post up for people to take a look at that. Every deposit's different and there's huge variability. So sometimes I wonder about the value of trying to summarize it into a short table, but at least it can give you some sense of that. Okay, so there's a fair bit on this slide, but just to sort of wrap up a little bit here, given the supply-demand fundamentals and the types of deposits, what are some of the considerations that your listeners can be thinking about? So I think the case for copper demand is strong. That strikes me as no doubt, and that there is an impending supply-demand gap. I think that also strikes me as pretty, almost a certainty. With that being said, short-term factors always affect the price. So, for example, recession concerns right now are dropping that price down. Medium to long-term projections for copper prices range from as low as $3.50, which I think is probably too conservative, to over $9, which is, maybe too high for a long-term metal price. But I think the key within that is there will be, let's say, between now and 2035, there will be run-ups in the copper prices over the coming years. At times, the concern about the supply-demand imbalance is really going to get heightened. And we will see that copper price jump up. But metal prices are cyclical, so it will come down again too. It's not going to be a steady trend of increasing copper prices to 2035. There's going to be some ups and downs. So, your opportunity is to take a look for those run-ups. If you can, get in advance of that. But if copper's really taken a big move up and the equity prices have followed, think about getting out at times like that. And hopefully, if you're lucky, there's a pullback, you can get back in. So just a point, I think, there in terms of, metal prices are always moving around. And while they may react to medium-term trends, there's always those short-term factors that influence the price. So during the periods of heightened interest with higher copper interest, there will be great opportunities in the junior and major sectors. I think that's a given too. Timing's always tricky, and that's going to be part of it. And then when evaluating exploration stocks, keep the geology in mind. What type of deposit is being explored for? What are its size and grade characteristics? And what does that mean for the length and grade of notable drill hole intersections that might move the market? So understanding whether drill hole intersections really above average, below, in the ballpark or not, I think can really help you get a sense of how that might move the share price for a given company. And I'll just wrap up here by a little bit of a promo. I do have a couple of upcoming Mining Essentials courses that are planned for anybody who is going to be in the Yukon in November as part of the Yukon Geoscience Forum. I'm actually doing the first in-person course, seems crazy, for a few years here, November 17th and 18th in Whitehorse. And you can go to yukongeoscience.ca to see that. I'm also going to be doing a course as part of Mineral Exploration Roundup that's based in Vancouver in January 2023. The short courses as part of Roundup this year are going to be online. So it's an online version, but I have developed a good engaging online course. So, if you can't make it to Vancouver, you can still do this course online. That's January 17th and 18th, 2023. And if you go to roundup.amebc.ca, you can see registration there. And then just as always, I do have some online short courses available hosted by Thinkific. You can go to miningcourses.thinkific.com to see those, or just go to my website, MiningEssentials.com, and there's links in there to the Thinkific courses. And I'm going to be looking to get links up to the other two live courses as well. So there we are. Thanks for that, Bill. Hopefully that was informative for your listeners.